Well, holy smokes, everybody. The economy and the markets that have been hooked on stimulus, the stimulus party where the markets have been roaring, it looks like we'll have a V-shaped recovery in the economy. They've all been partying on the stimulus. Well, it looks like now the party has ended and they're starting to feel the pain of the hangover. In this video, I'm going to go over the latest disastrous jobs report, US consumer confidence declining, US GDP growth that is slowing rapidly, and the implications this is going to have on the Federal Reserve's decisions and the markets. Okay, everybody, let's not waste any time. Let's get straight into it. Well, what the flippity flip flap plop, everybody. Look at this jobs report. It was a big disappointment. So it was only 235,000 positions added versus the expectations of 720,000. So that's just not a little miss, that is a big miss. And this is why, we can't always listen to the advice of the so-called experts. So also some news that's going to put some pressure on the Federal Reserve to taper is the unemployment rate fell down to 5.2%. So we're getting closer and closer to full employment. And you may think, well, you know what? People getting jobs, that means they'll spend money. This will be great for the stock market. Well, no. What's currently fueling this stock market is stimulus, and the markets are hooked on stimulus. So once this stimulus gets taken away, that's when we're going to see a sell-off in the markets. And also that means we get closer to lifting interest rates, which is also pumping the markets, because that means people have no choice but to put their money in the stock market. Otherwise, they're going to get no return with their cash in the bank account. Also, the story of temporary transitory inflation. It's not going to be temporary. It's not going to be transitory, everybody. Just like taking the US dollar off the gold standard wasn't temporary. Look at this. Wage growth is rising. Wages rose at 5.3% year over year, everybody. And we'll get into why this is later in the video and why you may think wages going up is great for workers, which it is good for workers. But if inflation is higher than the wage growth you're getting, and then that means companies are going to have to put up their prices even more to offset these higher wages, well, again, that's bad news for inflation, and that means the Federal Reserve is going to have to taper sooner, harder, and they're going to have to bring those interest rates forward to get this inflation problem under control. Because like I've been saying, the Federal Reserve is downplaying this. They're trying to con and scam America into thinking that inflation is good. They're trying to devalue the debt because there's no way the government can pay it back. And they're trying to lift the prices of everything up so the government can raise their taxes. So the experts at CNBC said August total was the worst since January and comes with heightened fears of the pandemic. We're seeing cases surging in the US. So even if they don't go into lockdowns, there are going to be some people that don't want to go out, that don't want to spend. So look at this chart, everybody. As you can see, in 2020 in April, jobs absolutely collapsed. There was 20.7 million jobs lost in the month of April. And really, it's not we're having jobs growth. People are just getting their jobs back that they lost. You can see in May, 600,000. In June, 900,000. In July, 1.1 million. Those look like we're having a great recovery in the jobs market. But now, not so much with just 235,000. So it goes on to say that most of the jobs growth has been in the leisure and hospitality sector recently. But now with COVID, maybe some businesses don't want to hire because they're not sure if they're going to get locked down the next week or the next month. Or some people that worked in this industry in 2020 that lost their jobs, they're probably not going to want to go back to these jobs because, again, the uncertainty. And the actual unemployment rate, it says here, in that industry actually went up to 9.1%. And so what industries are hiring the most right now? So professional and business services led gains with 74,000 new positions. Other gains was transport and warehousing, 53,000, and private education, 40,000, and manufacturing other services, 37,000. But have a look at this piece of data, everybody. This is very interesting. So the month saw an increase of 400,000 people that didn't want to work for pandemic-related reasons, pushing that total up to 5.6 million. And this goes hand in hand with this consumer confidence survey. A lot of consumers are getting worried because of higher inflation and because they don't know what's going to happen with their jobs in the future if all of a sudden there's a full-blown pandemic outbreak and then a full shutdown. Because look at this, everybody. This is a consumer confidence survey. So as we can see, before the pandemic, it was over 100. Then it collapsed to around 71. Then it rebounded to just below 90. But now it's actually crashed below what it was in April 2020. And why do you think that is, everybody? Well, what's happening right now? We've got the eviction moratorium ending. So people that maybe thought they could spend some more money on consumer goods, they're going to have to start paying their rent again. Mortgage forbearance is over. People are going to have to start paying their mortgages again. And this weekend, unemployment benefits are ending. And so one person's spending is another person's income. So those consumers are going to be feeling a lot less confident. And this is what's called a fiscal cliff. And we've just got some new data this month for wages that is going to attribute to higher inflation. Let's have a look, everyone. So US wages, as I said earlier, went up 4.3%. But actually this month they increased 0.6%. So if you annualize that, that's 7.2%, which proves inflation won't be transitory and it won't be temporary. And that means businesses are going to have to increase their costs to offset this higher labor costs. So this means the Federal Reserve's really playing a dangerous game right now, and they've kind of got two options. Either keep the stimulus going, keep the money printer going to try to get unemployment down, but then that means inflation's going to run higher. Or they could fight inflation and start tapering and lifting interest rates, but then that's going to affect the economy. So you can see people, they're pretty much stuffed either way. Because what are we seeing, everybody? It says here the participation rate is still far below the 63.3% in February. It's still just 61.7%. Now you may think, well, that's just because there's not enough jobs out there. Well, actually, there's a record amount of jobs out there. So placement firm Indeed estimates there are about 10.5 million openings now, easily a record for the US labor market. So why aren't people taking these jobs, everybody? Well, it's because they've been used to stimulus. They've been used to just getting money for doing nothing or not having to pay their bills because of the pandemic. So some people are getting used to this comfy lifestyle and they don't want to take those jobs. But that could be about to change with the unemployment benefits ending and the eviction moratorium ending. Also, they're saying now, as you can see here, everybody, the US GDP growth could be about to hit a speed bump. So everybody, what does this mean? This means although we've had a roaring economy, a bounce back, it's just been that, a bounce back. The economy is not really growing. And what we're seeing is the only reason it's been growing is because it's been an artificial fake boom from stimulus and from centralized control from governments propping up the stock market and the housing market to try to get growth. But reality is now starting to hit. People are starting to feel the effects of the economic stimulus hangover, and now things aren't looking as good as it seemed. But everyone, it's going to take us a couple months to get this data to show the economy weakening, to show US house price growth declining, and to show inflation's not transitory. But don't worry, I'll keep you updated every step of the way. But that was just my thoughts and opinions on what's going on with the jobs market, with the economy, and some decisions the Federal Reserve is going to have to make. What do you think? Let me know. Okay, see ya.